Well, hello everyone. Thank you for joining today's webinar titled From Multiples to Momentum, How IT Valuations Are Evolving in 2026. My name is Taylor Gritzner, Community Engagement Manager here at ITV. We are joined by Reed Warren, CEO, Corey Kearns, VP of M&A, and our special guest, Nick Rucker, CEO of Blue Alliance. So thank you all for being here. We're especially excited to have you, Nick, to provide insight from a buyer's perspective on what you're seeing in the market today and what's really driving premium valuations.
Thanks for having me.
Absolutely. So for those who have been on the webinars before, you'll probably notice that this is my first time hosting an ITV webinar, and I hear it's tradition to give away a $25 Amazon gift card to the attendee that can correctly guess a trivia question about our guest. So to carry on the tradition, I asked Nick last week what trivia question we should put out there, and he said that he did pick up a sport in his adult life, that his very athletic family debates is actually a sport, but Nick insists it is. So please feel free to put your guesses in the chat as to what sport Nick picked up in his adult life, and we will announce the winner at the end of today's webcast. Nick did agree as well to give you all a hint that it involves speed, but no jumping ability is required. So there we go.
Everybody's on the edge of their seat.
There you go.
Yeah.
Hey, it is, and I know Taylor, you're getting introduction, but I know I recognize a lot of the people that have been that are on here. You've been here before. We're just really excited to have Taylor Gritzner on the team. Had the privilege of knowing her from Evolve, and she actually used to work with Corey in the past. So there's some definitely strong relationship there. But really excited that she's been picking up the ball, picking up where Aaron left off on a lot of the marketing stuff. A lot of you guys knew Aaron and loved Aaron. And I'm just going to say we've got equal, if not greater, affection for the record for Taylor and just what she's doing here at IT Valuations. So welcome to your first one, Taylor. It'll be the first of many, and glad to have you on this and hosting this.
Well, I really appreciate that, Reed. So while everyone's putting their guesses in the chat, I have a few quick housekeeping items before we jump in here. We have a few upcoming webinars this spring, just in time for tax season. Greg Northrop and Chris Parker of IT Tax Services will be joining me to share more about the R&D tax credit, which is a hidden tax credit opportunity that more and more MSPs are starting to take advantage of. And then we'll take a pause for spring break and then pick things back up in mid-April with Bob Gensler and Reed as they talk through the emotional side of selling. Bob will share just his personal story about navigating life post-transaction and provide tips and things that sellers should keep in mind as they transition into a new phase of life. So if either of these topics pique your interest, we'd love to have you join us for these. You can find them at itvaluations.com/webinars. And then again, today we're talking with Reed and Corey of ITV and Nick Rucker of Blue Alliance. Reed and Corey, if you don't mind just doing a quick introductions of yourselves and your background, then I'll quickly give an overview of IT Valuations, and then we can have Nick share a little bit more about himself and Blue Alliance.
Yeah, so jumping in real quick on this, most of you guys know me, CEO of IT Valuations. I've been doing this for now 16 years, and great to have Corey on and Nick. I'm just going to briefly touch on Nick. Great relationship with Nick. Nick used to be a former client of ours, but is somebody who I just deeply respect. And so when we have this conversation here today and just the things that he's seeing, he's definitely somebody I listen to and is informally on our advisory board, just giving us wisdom and guidance from his years of experience as both an entrepreneur and as a business builder, and he's just accomplished so much, and just so grateful to have the relationship with him, and so grateful to have him on this panel with us. So,
thank you.
Real quick, I think it's a blast from the past. A little bit for me is before I joined ITV, I was actually helping these two gentlemen in some prior engagements that they had, right? And so it's kind of full circle here a little bit, and don't hold it against Taylor that she used to work with me, for anybody on the record. And then what I always tell everybody for my introduction is Reed sells the dream and I fix the nightmares, is what I tell everybody. So
well, it's very nice to meet everybody. I'm Nick Rucker. I'm an entrepreneur. I started my MSP back in 2002. I had the privilege of founding two other healthcare related businesses. My original MSP, Path Forward IT, which is part of the Blue Alliance family today, is all healthcare, and had started two other healthcare businesses. And then as the activity in our beloved MSP marketplace started to pick up in the 2000 teens, I had the wild idea of seeing if I could start a platform myself. So myself and a few other brave MSP operators, we started an operator-led platform. So on our own, we did a total of 9 acquisitions before partnering with any outside capital. And fundamentally, we wanted to build what I'll call the common sense platform. There's a lot of great partners out there for MSPs. I think what makes us unique is the relationship first component. So really taking time to understand founder shareholder goals, building customized plans. Our platform is not built on static rules. It's built on finding common sense solutions that create value for everybody involved. So lots of flexibility. We also think highly of scaled and verticalized MSPs. And so while we do acquisitions, we're not going to end up with 15 to 20 plus brands on our platform. We want to be really wise about welcoming partners in that stand independently when they have a truly unique end market right to win, which we'll talk about later today. Or if a partner's joining and for whatever reason it makes more sense to join one of our already scaled MSPs, sometimes that's the right choice. So bottom line for Blue Alliance is flexibility for founders and treating all of our partners equal. Everybody who joins is all at the same level. So hopefully that's a good summary. Happy to answer more questions anytime.
No, it's really good, Nick. And I just think one of the things that we got into and got the privilege of being part of Nick's story. First of all, I love one of your platforms was Skynet, which is taken right out of Terminator, which is fun side story. That was almost a trivia question, by the way.
I believe it.
But then also, I think one of the things that just really have been impressed with you and what Blue Alliance has become is, and if you want to just take a little bit of time, because I really feel like it is such a differentiator from. So let me just back up. Obviously, private equity firms have different differentiators. Not every private equity firm is the right, or platform is the right platform for every buyer that's out there. And so just one of the things, Nick, I really appreciated about you and it differentiates you is if you want to just talk about your kind of blueprint of freedom, because I feel like that's just such a cornerstone to who Blue Alliance is and your acquisitive strategy that you have going on.
Yeah, so Sean, my co-founder and I, and when we first started the business, we wanted to define our own process. And so we just started by thinking like, how would we want to be treated as entrepreneurs? I think many of us in the MSP world, we never expected to be successful. And while we're blessed to have gotten there, it's not always the clearest path and the clearest plan. So the assumption that we know exactly what we want at the outset of a transaction, I think, is sometimes not true. So we started a process we call Blueprint to Freedom. It's basically a structured interview. We spend time with the founders and shareholders of the business we're talking to, partnering with, and we really try to understand their goals from their perspective. How do they feel about their team? What do they want to see happen with that team a year from now? What do they want to be true about their customers? What do they want to be true about their legacy? It's a way to essentially create like a vivid vision of what do you want to be true a year, 2 years from now if this transaction is successful. We take that information and turn it into a written deliverable back to the founders or the shareholders. And it really should be like a mirror. Like if we got it right, whether you agree with our plan or not, that's not the point of the tool. The point of the tool is to say, here is what we heard and here is what our platform can or can't do. We just think starting relationships like that with transparency, it's just the right thing to do. And while everybody wants to get the most money in the transaction, it's not the most important thing in my opinion. And so partnership for us always comes first. And that's why we do that Blueprint to Freedom process. And we think it's unique. We think it's something that it's not unique because of the idea. It's unique because the people doing it are fellow founders. And we understand things from a perspective that you can only gain having lived through this experience.
That's really cool. Taylor, I'm sorry. We'll let you get on with the presentation because we're already derailing you. So
You're all good. Expected nothing less. But again, thank you so much for being here, Nick. And we're really excited to have a buyer's perspective on today's webinar. So to jump in, Nick, maybe help us set the scene on the current environment. From a buyer's seat today, what does the current M&A market actually reward? And how has that changed over the last couple of years?
Yeah, it's a great question. the idea or this concept of like flight to quality is kind of how I would describe it. And what I mean by that is, if you look at the last couple of years prior to now, there was a lot of focus on recurring revenue and in some cases having a pulse, and that was enough to get a deal done. And as buyers have gotten more sophisticated, as platforms have gotten more sophisticated, there's been a lot of lessons learned that I think people are starting to get realistic and honest about. So things where maybe they got burned by a tuck-in or a partner that didn't integrate well. And what that's doing is causing us to ask better questions about quality. So what does quality mean in the context of an MSP, right? So I founded an MSP. I think we all think we have good MSPs. So this isn't an indictment, right? The fundamentals still matter. Gross margins matter. Your revenue retention matters. Your CSAT matters. All those things are good, but what I want to help educate the group on is that the smart buyers are getting better at looking even deeper. So let me give you some real world examples. Rather than saying you have account management, have you systematized account management in a way that when the business transfers ownership, we can feel confident that we can serve the stakeholders on your team that are taking care of the customers, and in turn, they can keep serving the customers in a way that doesn't disrupt that relationship. Does your team at the engineering level understand their ticket times, how things are posted, how their work contributes to the margin of a customer? Has that information moved down, and are people empowered with reports and data to be able to be part of that outcome? Many MSPs still use CSAT scores. I think we all agree, we all have like 98, 99% CSAT. Like I've never seen a book where somebody's like, we're at like 85. Like it just doesn't happen. Everybody's at 98. So that can't be true, right? Like we know intuitively that can't be true. So an example is, has the business moved past CSAT to something like Net Promoter, where you're really getting to the people that are making buying decisions and understanding how they feel about the value of the service provided, not just how individual ticket respondents are feeling. Another example is contract quality. So contracts are important. We all know that, but sort of understanding the mechanics of the contract. Are there automatic price increases built in? What are the terms? Are they equitable for the customer? I think a lot of buyers have experienced inheriting bad contracts, and we often do it with a lot of optimism about our ability to convert those to something more equitable, and that just doesn't happen. And so really diving into sort of the mechanics of your agreements and how those price increases have been historically handled is important. And then I'll sort of end here, but I'm happy to keep going on this topic. But I think financial maturity is really important. And this is something I take to heart. As an entrepreneur, I feel like the answer to everything is yes. Like, yes, we should do that. We should buy that. And as I'm growing and maturing as a leader, the answer can't always be yes. Like you have to say no to some stuff. And so understanding like how the decision makers are empowered with data, what are the financial rhythms of reviewing that data, and is it exposed to the entire team? That helps us understand how a business is going to respond when a partner like Blue steps in and starts trying to create or increase that data visibility. It can be a culture shock if they haven't had any prep for it.
Yeah, probably the thing I'd just add to that real quickly. So first of all, Nick, you're right. Of all the valuation work we do and all the conversation we have with people, it's only maybe 10% of companies that'll actually say, hey, I think we're below average, right? Until everybody believes that they're above average from that perspective. But I would also just say if you were to go back to 22, I mean, truly, like you mentioned, if you could fog a mirror and had recurring revenue, we could acquire you. But then we got to look at the fact that interest rates were so low, there was so much margin for error. And what we've seen with the interest rates going up and with inflation going up from a macroeconomic perspective, it doesn't leave room for error. And so it has really forced a lot of private equity firms to really dig in. And we've seen this, and Corey, you can jump in on the due diligence side. We've just seen due diligence really become very grueling, because I got to make sure that there's not hidden stuff here, because I can't actually afford to make the investment into you as the seller and get to my return unless I know that I've removed as much of the risk, or as much of the risk as absolutely possible.
Yeah. And one thing to just add for the group, just as we're talking through this, if anybody has any questions, just throw them in the chat. We're happy to go sideways if you guys want to dive into a topic further, right? Because that's part of this. That's where the engagement is. Nick, you didn't say it, but I think what you're implying, which I agree, is making sure the narrative aligns with the metrics, right? For you use the example there saying like we're really good at account management. Well, does the metrics into the financials show that as well, right? That's a big piece I think buyers are honing in on and saying, okay, let's look at this individually and say, what are you really good at? And let's make sure that it's actually carrying forward, right? So do you have good expansion and cross sell, upsell, right? Like that's a really simple example, what you alluded there, account management, but it really just depends on what the topic of discussion is. It's evolved from like, yeah, we're really good to say like, okay, let's trace that through whatever it is, whether it's service delivery or finance or sales, is a really big thing that I've seen buyers look at individual opportunities versus just taking a blanket statement across this is how we do valuations and here's how we look at opportunities. It's kind of what I heard from you a little bit there, Nick.
No, I think that's spot on, Corey. I mean, it's like proof of life for each of those things.
Yeah.
Our industry, I think our industry is a lot of things really well. And one of the things we do well is educate.
Yeah.
And I think organizations like ITV are a great example of that. Peer groups are a great example of that. We've all gotten really good at putting our absolute best foot forward when it's time to market the business. And that makes it harder to really see what's going on. It doesn't mean it's bad. It just
Right.
means it has to be rationalized as it relates to value. And I think that rationalization is what we're seeing is buyers are just getting better at peeling back the lipstick, if you will, and understanding like, hey, what's really there and what work am I going to have to put in to bring it to the level we need it to be?
Yeah, and sooner in the process too. I've noticed it happens sooner in conversations, and a lot of times I think in historical years it was kind of post LOI or post negotiations. It's actually no, a lot of these conversations are the front load because the margin of error is just less to your point, Reed, in that diligence process.
Well, and I really like it. I mean, account manager is such a great thing, Nick, that you're talking about. Because really, when you talk about saying, hey, I've got to create account management from a metrics perspective, we track this within valuation of service. We call it net revenue expansion. So how much revenue are you actually driving out of your existing customer base? Well, that's account management, right? And so when you should be getting 5% in rate increases, and you should be getting at least 3 to as much as 5, 6% in cross-selling, upselling. And if your customer base is growing even at an inflationary rate, you should be able to string together pretty easily 13 to 15% organic growth without putting a new logo on the board. So when you tell me you've got good account management, I totally agree with Nick. You need to back it up with process, but from a metrics and analytics perspective, I should see that within just that one metric alone, net revenue expansion.
And to shift gears a little bit here, many MSPs inherently try to sell at peak financial performance, but the snapshot in time doesn't always paint the full picture from a buyer's seat. So, Nick, how do you determine whether growth is sustainable and transferable versus just a moment in time?
Right, the old buy low, sell high. So I think that I think we all understandably want to do that, but there are some things. I think the easiest concept to think about is this: when you put yourself in the seat of a buyer is trying to buy an engine. We don't want to buy a snapshot. We want to buy an engine that's going to produce the same results. And we talk about exit multiples so much in our industry, we forget that fundamentally, whatever that multiple is, you're essentially betting that the business engine will produce that same result for however number of years you put on that multiple. And so it's easy to kind of forget what we're talking about, but that's how we have to think about it is, are we looking at peak or are we looking at a normalized example? So some of the ways we do that, at least in our buying process, while most of the time in these kinds of transactions, your trailing 12 months is really a focal point, we look beyond that. We want to understand what's been the story and trend even in prior years. So looking at a 3-year window to understand if there's been a huge windfall or potentially an outsized client growth that's contributing. And then what does it look like if that wasn't there? The other thing we think about is transferability. If there are parts of the business that are successful, say for, in periods of my career, I'm guilty of this. There were parts of the history of Path Forward where if you pulled me out, it would have collapsed. In 2010, where I was the sales guy, the accountant, the HR guy, we try to look for things that aren't going to transfer, that are going to weaken the business's ability to continue to perform at that same level. I think that's a big example. Organic growth is really important when you're thinking about sustainability versus peak performance. Understanding what's happening there. Another example that we see often, and I'd love to hear Reed and Corey's perspective on this, but for example, if we see a business and let's say that they have 50% gross margins, and we look a layer down and there is a relatively light leadership team, there are business building investments that have to be made for an organization to maintain those kinds of margins at continued scale. Like, we're not buying a business because we want to keep it the same size. if we do our jobs right, we want to create an ecosystem where those businesses can grow and double and triple in size, but you want those unit economics to stay the same. And if you look at a business that's got great margins, often sellers thinking like, hey, look at this, I'm best in class, and we look at it and it's not that we're knocking it. It's like, no, that's great. And if you kind of stayed the same size, you could probably continue to generate those results. But if we double this or triple this, there's significant business building investments. There's nowhere for that margin to go, but down a little bit until it normalizes. So that's I think where we spend the most time, and it's a very delicate conversation. In no way is it a criticism of the business necessarily, because they haven't gotten to the scale where they've seen the business building investments that are needed. So it's our job to sort of help them understand, like, look, we're not trying to just knock the price down. This is what we want to do to make all of the things we've promised you about legacy, taking care of your people, taking care of your customers. In order for us to make that true, these are the investments we're going to have to make. And that's why it impacts the pricing conversation. So Reed and Corey, is that kind of what you guys see too?
Definitely agree. Sorry, Corey. Just two comments on that. We love what you said about it. The value of the business is what's sustainable and transferable. That is just an absolute fundamental truth, and people don't often think about it. And the degree to which it's not transferable or not sustainable is going to negatively impact value. So when I see an organization that's not necessarily sustainable and transferable, and that's when you start to layer in a lot of these contingency type structures of earnouts and conditional seller notes and things like that, so that, hey, I can only really afford to pay for what actually can be transferred and what can actually be sustained. I think to your point on gross margins even more so, and I'm just going to jump at it from a valuation perspective, and Corey, you can jump on the transactions, but from a valuation perspective, we spend a lot of time actually looking at labor efficiency ratio. So when you think about your direct labor, for every dollar you spend on direct labor, you should be getting $2.80 to $3 of gross margin. But I'll tell you, if you're getting $5 of gross margin, you're going to be crushing it from a gross margin perspective. But every buyer and every good evaluator is going to look at that and say, boy, your team is running hot. This is not sustainable. You don't have enough capacity to be able to sustain growth. And so looking at your direct labor efficiency ratio, looking at your management labor is similarly where you should be, for every dollar you spend on management labor, you should be getting $5 in gross margin on that management labor. We just see time and time again that people have excessive management, and it's actually pulling the business down. Now, conversely, we look at the other side of it and say, hey, look, if you're running real lean, it's like, I'm sorry, but now we've actually, from a buyer's perspective, have to layer in additional costs to staff the team appropriately, because we know, because we've been down this road. And Nick, you've been there, you grew the business from $0 to I think over 80, 90 million. And you've seen those capacity constraints, and it's just like nobody's exempt from them. You can get more efficient with the process, and you can use offshore labor, and there's things you can do to tweak it, but you fundamentally can't break the rules.
Yeah, in real time, while we're having this kind of discussion, everybody's trying to figure out how AI enters the room, and can you create better, more sustainable margins through AI? So I know we're going to talk about that later, but a lot of this commentary was based on sort of current state where human capital was still largely the delivery mechanism, but now we're at this inflection point where that might be shifting.
Yeah, I think you both hit the nail on the head, but what I often do with potential sellers, they get stuck into like, well, it's going to impact the transaction. But what I like to do is actually walk them through, say, okay, let's take that off the table. Let's just use an example. You're at 10 million today. What would it take for you to get to 20 million? Well, then they have to walk through a strategic planning process to say, well, I would need to add this, or I need to do that. Well, that's actually what you're describing, Nick, is like, what is it going to take for the business to double, triple in size? And you have to be prepared as a potential seller to have that dialogue with the buyer to say, here's what my plan would be, because you have to have a strategic plan going into it, regardless if you go through a transaction or not. And you can't sit in front of a prospective buyer who's like, well, I know I'm not going to reinvest in my business, right? That's oftentimes where we spend a ton of time on the prep work, talking through what a plan looks like, because that's what the dialogue is going to be. That's why you as a buyer are interested in this business, not to run it at the current state. So I take numbers aside and just view the lens out a little bit and say, what's this look like in 3 years? Let's put that plan in place. And then let's be prepared to have that dialogue and where we think strategic investments need to be had. Because that's where I think the great conversations that I've seen in transactions is less about like negotiation on price and more about let's do this together. Let's see how it looks together type of conversation, to your point, Nick.
And just coming back, I'm just going to tell you, a lot of people think that well, I'm just a unicorn and it's just going to really happen this way. I would just say there's a metric for everything. And so when you talk about selling on the way up, you want to sell on the way up. How do we know you're at the peak? Well, we're going to look at the metrics, and we're going to look at labor efficiency ratios, and we're going to look at gross margin per employee. We're going to look at these things to tell us if you're at your peak or you're nearing it, and how sustainable it is beyond that. And I would just say there's in the managed services space, there's only so much innovation that's come around. We'll talk about AI in a minute because I think it's a disruptor. There's only so many levers of efficiency that you can pull before you start to realize, hey, this thing is propped up. And as soon as a buyer looks at the numbers and say, hey, this thing's propped up, the value of your business is actually is already starting to descend, because in the end, what it's telling the buyer is the buyer's now is going to have to be able to make investments for this to be able to grow any further than it is today. And so from a buyer's perspective, we really want to be able to see, hey, you've got capacity, you've got good process, you have a future that's sustainable. I realize we're going to have to make investments, but we're not have to do it on day one. We can do it month 12 because you actually have capacity to be able to do it. You can actually get through into that run rate and realize that from a transferability perspective and not be leaving the buyer with a hole in the bag. So.
And then sticking on the topic of sustainability, sometimes a business can look great on paper until buyers really dig into the customer base. Nick, from your perspective, how do you evaluate client concentration, and at what point does it start to affect value or deal certainty?
Yeah, I mean, look, I have a lot of empathy on this. I mean, when I started the business with no dollars and no customers, like we were 100% client concentration for like the first year. And then, there's a lot in the growth curve where, it thins out and then you end up with a couple of whales. So we're very sensitive to this, and we don't necessarily automatically treat it as a concern. But I'll tell you, Taylor, to answer your question, a single client at 10% of total revenue starts to get our attention. Over 15%, that's a pretty meaningful risk factor. Another example would be if you had 3 customers that were 30% of the business, right? That fundamentally changes how we look at the business. And it's not necessarily just about percentage. I think sophisticated buyers who want to get deals done and not just nickel and dime things, the way we look at it is it's about replaceability. Like if your biggest customer is 12% of your revenue, but they're on a 3-year contract with strong renewal history, and we can really dig in, understand the relational depth, the people that are serving the team in that tenure. Like we get how this business works because we built these businesses. These are relationship businesses. So Blue can get comfortable if we can get access to that information to understand the likelihood of that happening. Conversely, if that 12% customer was month to month, that's a bigger deal. So what that starts to do is it doesn't necessarily kill a deal. It just means we change the terms. It means we have to create something that's fair for both sides, right? Because the seller is saying, don't worry, it's going to be great, and I'm going to make sure that this customer, is here for the next 2 years. And we're saying like, hey, we're going to operate the business in a really stable manner that's not going to disrupt the customer. Like both sides are kind of making a promise. So when you introduce structure where maybe there's a holdback or some sort of a payment tied to retention to certain customers or tied to sort of revenue, if in the following 12 to 24 months, those can create a fairness that lets us get past those things. But that's kind of how I think about it: is 10% is the threshold where I'd start to pay attention. 15% for any one customer, I would definitely start to think about about the risks there.
Mm.
Yeah, we're in the middle of a transaction. So this comes back to sustainability and transferability, right, of the business. And so that's where we do a lot with conditional seller notes. It says, hey, you meet these conditions of these customers staying, so I can prove that you've transferred 100% of the business, but I won't give you 100% of the value. But if one of those customers leaves, then 100% of the value hasn't been transferred, right? And so part of the reason we like some of those factors and variables in a controllable way. But yes, I think the other thing that we're seeing, and again, I'm just trying to put it out there from the transaction side. Pre-LOI, everything's taken in good faith. You tell us about what's in the business, we believe you that this is what's going on. But as soon as you sign the letter of intent, you go to due diligence, you're going to move from good faith to good fact. And candidly, the whole goal of due diligence is actually to validate the truth. And so the best thing I can tell for anybody thinking about selling is be truthful and candid about it. Don't do that. I hope they don't figure it out because they will. We've seen enough businesses, buyers have seen a lot of things. We will figure it out. And so one of the things that we're also seeing, I just want to call this out because it is a concern, is that you may have common ownership amongst your customers. So in other words, if you've worked with a private equity firm, well, they may own, 30 companies, and those 30 companies are all clients, but they still have one common owner. That's customer concentration, even though it may not be apparent at a surface level when I get the customer list. But I'm just going to tell you, it's to your advantage to disclose that in advance or as part of delivering those initial documents and corporate overviews, just because it sets the stage of trust to be able to call that out in advance.
I think that's great advice, Reed.
Yeah, and I always oftentimes when I'm helping prep and talking to people, they always ask about customer concentration. Unfortunately, the answer it depends, right? To your point, Nick. What I would tell people is be thinking about who holds those relationships with those key clients, right? And one recommendation I'd have is making sure it's multiple people, because if the principal owner is the key account manager on those accounts, but also has a short transition, well, that's a different story than, hey, I've got an entire team, they interact with this client on a daily basis. And so it's multi-layered, right? So think about succession planning for your clients, not only for your business as it relates to your leadership, right? So I think, Taylor, it really depends, right? To Nick's point, what's the retention of that account? When's the contract renewal date? Like we, everybody can overcome it as long as the facts are on the table and there's good dialogue on how do we make sure it's transferable. And a lot of times there's actually areas for growth within those current accounts within a buyer and a seller, just as long as they have the right conversation. So my advice is if you have client concentration, it's not a bad thing. Just be mindful of it. And how do you reduce the risk if you do plan to transact someday? And it's fairly easy to overcome with the right planning and dialogue up front.
Yeah, and I would just say, just right on those lines, and I also want to address the question that kind of came through there, but sorry, now I lost my train of thought thinking about the question that was coming through there.
You're so excited about LER that you just,
Yeah,
just go straight to it. It's
we're
fine.
just going to jump to
it,
LER. So just real quickly on that, the question came up, do we track labor efficiency ratios? We actually track three predominant ratios when it comes to efficiency. So one is, well, four actually. One is total labor efficiency ratio, which would be about right around 2, which is for every dollar you spend on labor, you should be getting $2 in gross margin. That breaks down separately into direct labor efficiency ratios and then management labor efficiency ratios. So direct labor is really looking at your cost of good labor and your cost of goods sold, or anybody who touches the delivery should be counted in that COGS expense. Then the other one that we look at is, we call it operational efficiency ratio. It's really the rule of 40, which is looking at your growth rate plus EBITDA. If you have a firm that is completely efficient, it should have potentially as much as a 40% top line growth. No surprise, it'll have 0% profitability. You could have on the other side, and we have clients that do both, 40% EBITDA, and no surprise, it'll be have 0% growth. Either of those, obviously, those are the two extremes, but you really want to balance that with about a 20 to 25% top line growth with 15 to 25% bottom line. What that tells an investor and what that tells a buyer is that this business, this organization is completely efficient. There's no waste happening within the business. And so you can blend those growth and profitability amounts back and forth, but as long as they're landing between 35 and 40, tells me that you're running a highly efficient organization. That's also going to match to your labor efficiency ratios on that. So all good questions. We do track that within our Valuations as a Service product.
Awesome. And then coming back to the fun topic of AI, Nick, in our prep call, you mentioned that buyers are increasingly pricing deals based on operational maturity, things like cybersecurity, compliance, and AI readiness. From a buyer's perspective, what capabilities today actually signal a higher quality MSP and justify a premium?
Yeah, it's very similar to what I talked about in the first response, where this sort of flight to quality, this is like a subsection of that. So we all know that cybersecurity has become table stakes for all of us. And it's not just having a good MDR, XDR tool, it's having individuals dedicated to some sort of cybersecurity service. And that can look different based on the size of the MSP. If we're talking to a business that's got 100 people, I would expect there is a team that's specialized, trained, and uniquely equipped to deal with the cyber needs of the customers, and that there's a specific, carve out in the scope, hopefully as an independent service that you're offering the customer that's increasing the value of the customer, but also the value of your agreement with them. Alternatively, if you're a smaller business, it would just mean that you've got people that are focused on that. You have documented incident response. You have a clear ability to articulate the value proposition and not just throw a resold product in your per user stack. I think that's the first part of it. The second part is GRC offerings. We've all talked a lot about this, and personally, this is an area where Blue invested early in 2021 and built out a GRC offering, and we've had a tremendous amount of success. I think the hype on that is real. CMMC has transformed the landscape for a lot of businesses, and that count of businesses is increasing downstream. Already regulated industries like healthcare and financial services, they're expecting more and more for their technology provider to be not only literate in those frameworks, but also able to provide service that like already speaks to them, that they're set up, that they can actually be documenting things. So what's an example of that? Does your MSP have a real living change management process? Like, can I come into your business and look at your change logs? Can I look at the minutes from your standing change committee? Do I see evidence of ticket flow where when something hits the ITIL definition of change, it's actually going through some sort of unique process versus just getting routed and solved and not necessarily documented? So if one of your customers is, SOC 2 Type 2, that's something they're going to need to be able to demonstrate. And so now by you having that process, it just makes it a better fit. So GRC isn't just about consulting with the customer and helping them. It's also about operating your business in a way that helps them meet compliance just inherently as part of the work you do. And then AI is an interesting one. I think if anybody tells you they know the answer to all this right now, I don't know, they're smarter than me. I'll leave it at that. But it's clear AI is going to transform our industry. And I'm sure all of us are like, none of us want to be Blockbuster Video and wake up and realize that we have lost the plot, so to speak. So I think it's good that we're all investigating. I just don't think we know what the right path is, but there's really two forks. It's internally, how am I using AI to reduce cost, to improve efficiency, to improve the customer experience? And then externally, what service offerings am I bringing to my customers who are trying to navigate this at the exact same time we are? Because we don't know the answer, Taylor, we're not looking for something in particular. What we're looking is for evidence of prior evolution and reinvention. MSPs have already gone through a little bit of this in our history with some of the changes in cyber, all of the things that have happened around GRC. If we're looking at a business and we see that evidence of them adapting, creating new service offerings, having new specialized team members, that gives us a lot of confidence that they've already got the muscle memory they need to navigate the change of pace that AI is going to bring. If we don't see that evidence, it worries us a little bit that is this business flexible enough and tensile enough to make the change that's going to have to adapt to how AI is going to impact us. So I want to be clear about that. It's not like we're looking for a particular product or a particular AI solution. There's a lot of them. I've seen some really creative ones, some open source, some buying products on the channel, and some partnering with hyperscaler tech. Like, all good. It's just, are they able to reinvent? That's the most important differentiator.
Real quick, just because I know Nick's super knowledgeable, just for the group, GRC, governance risk compliance, just for anybody that's not in the highly regulated, Nick, just to help clarify what you mean by GRC, I think is helpful for people there. So just a clarifying point there. And I think that's what I would echo Nick's point here, Taylor, is it's about the posture, right? One, to de-risk, right? Because as a buyer is going to look at that and say, it's like, what am I inheriting that I'm not aware of from a cybersecurity standpoint is super critical. And transparently, it's a soapbox of mine. If a seller or buyer says they got it figured out in AI, I think people are already kind of like on their heels to say, like, really? Like, nobody today can say that, unfortunately. And so it's more about saying, like, here's how I think about it, but I'm very open to input and feedback. And that's part of the reason why I think a lot of times people are having conversations because they don't know what to do and they're looking for a partner to help them navigate that. But if they haven't showcased their ability to have the right posture and approach, that's more critical than having the answers at today's landscape, in my opinion.
Yeah, we're definitely seeing a consolidation. The end as technology gets more complex, especially as AI starts to layer into it, the end customer is expecting their managed service provider to be the one-stop shop to cover all this stuff, right? And so you really do run the risk as you look at being competitive in the marketplace. If you don't have adoption around GRC, if you don't have adoption around AI, cybersecurity, and these different elements, the end customer is going to start to look for a provider who can cover it all, because in the end, they can't afford to have people pointing fingers at, well, it's not my fault, it's the other company's fault. And so really looking for really the managed service provider to really truly be. I know there's been a lot of talk about TSPs, technology service provider, but really that continues to be a theme as we go forward, and buyers are looking more and more for those companies that can really cover those bases confidently. Doesn't necessarily mean you have to do it all yourself, but you're not ignoring any one of those key critical elements as a part of your MSP.
And we did have a good question in the chat. Ernesto asked, is there a marquee deal of the last year where you saw next gen operations and exceptional history that led to a premium valuation?
Corey, you want to take that or?
Yeah, I'm trying. I mean, it's
No?
been already a year, so I'm trying to think about the deals from last year to be fully transparent. We had a lot of great deals, and hopefully none of my previous clients are on here, so I don't shortcome them. But I think they're all great deals last year, first and foremost. But there was one, and I would say they were actually kind of up and coming from an operations and maturity, so they didn't have everything figured out, but they had a really good roadmap and a game plan that led to a great narrative where buyer and seller had good synergies, where there was a premium valuation more so for to Nick's point earlier, on a future outlook of the business versus the historical performance. And so it was more about really good sales and marketing efforts that are leading to good future opportunities with a really good baseline and good operational framework that the buyer saw as a really great opportunity. So it's a really good question. And that's where I think it just depends on each deal, and buyer and seller is going to evaluate it differently. So there's one, can't disclose obviously too much information, but it was a good opportunity for both buyer and seller that I thought was a win-win.
Yeah, I'll add to that. I mean, just we look at a lot of businesses, and there is demonstrable evidence in the marketplace of an increase in multiple valuation if you can hit some of these kind of next gen features. So I will say, for the person who asked the question, it's real. There's a lot of things though that have to be true. Like some scale is required. There's a couple of things you have to look at, but there's definitely a premium paid for these more advanced operational businesses.
Mm-hmm. In size, to
Yeah,
Nick, your point, it
Yeah.
was a bigger deal. Not to say bigger is always better. It just has more scalability, to your point.
Well, and I want to touch that from a kind of a outlook perspective as well. We definitely see from a multiples perspective that top quartile firms that continue to innovate, continue to adapt on the technologies, that we actually see that their multiples, Nick's going to not like this, are continuing to kind of climb as they go forward. But we're seeing just greater separation between the top quartile, the middle category, and the bottom category, where we definitely see that the average MSP that is less adaptive, their valuation multiples or transaction multiples are actually in retracing. It's not like they're disintegrating, but there's more and more options out there in the market today. We see more sellers coming to the market today. As a result, buyers don't have to buy the inventories there. They actually have choices. And so as a result, we see those middle of the road average MSP multiples retracing and in a slow decline. But more importantly, if for those that really don't adapt well to the marketplace and to the industry, we're actually seeing that lower third class of MSPs, their multiples are declining very, very rapidly. And so when we have companies that are coming to us and say, hey, I'm thinking about selling this whole AI thing, just it's more than I want to adapt to and I want to sell. Well, now's a good time to sell, but unfortunately what started to happen in that marketplace, it shows a business that isn't market resilient. As a result, you will get a lower multiple, a lower transaction as a general rule for not having that market resilient business to take to market. And so we are seeing that just an unfortunate reality as the market moves from a seller's market, which it's been 22 to through about 25. We're seeing that market start to shift to become much more of a balanced market where there's plenty of buyers and plenty of sellers. That gives buyers more options. They'll continue to pay premiums for best in class, but they're going to pay less for some of the suboptimal firms that are coming to market.
Awesome. And in the interest of time, we might have to skip through a few of these. So might have to do a part 2 to this webinar series at some point. But to close us out, Nick, a lot of owners spend years preparing for a transaction, but very little time thinking about what their role actually looks like afterward. From your experience, what should sellers understand about life after closing before choosing a partner?
Yeah, real quickly, first thing I would say is, when you're exiting, spend some time really to get to know the capital partner in the business. This is something where I feel extremely blessed. Blue Alliance is partnered with a group called Prairie Capital. They're great people. We are values aligned. We make decisions the same way. I'm never afraid to bring them into a conversation with a new partner. I think it is so important. You can't think of the equity partner as like a sideline partner in any business. They're part of the DNA of that business. So I would start by doing your diligence on who the real backers of the business are, because that's a big deal. How does that inform your role? It informs your role in the sense of understanding who you're partnering with might change what you want to do. Like there's a lot of creativity on what founders can do. The answer isn't always just exit or stay. Like sometimes there's new opportunities for them that they haven't thought of, and that's what we really pride ourselves on, is looking for those opportunities when the rest of the deal terms aligned. Like let's find a way to use what this entrepreneur warrior has learned over the past X number of decades, for the good of the platform. But I do think you're right, Taylor. Like you have to start with sort of like faith, family. What are your personal goals? Make those decisions before you get into a transaction, then vetting the platform, the equity partner. Those things are much easier if you know what's important to you. We can't tell you that. That's what Blueprint to Freedom does, is it's us asking you what's important, but ultimately you should have those things sorted out with your family and yourself before you start a transaction.
Reid or Corey, anything else to add to that?
I mean, I think Nick nailed it there, right? Is having that up front is going to be critical, because in the heat of the moment, it's going to be challenging, right? But I think Nick's point there is just understanding who you're going to be working with, because this is ideally a long-term partnership. It's not just like a set it and forget it type of thing. So I think Nick's point around who's all involved in the future is really critical for everybody, whether you're on the buy side or the sell side. I think that applies to both groups here.
Yeah, and I would just say from a transaction perspective, knowing what you want to do is super important to have thought through that, because that will actually depict who the right buyer is for your organization. The other thing when it comes to, and Nick's been through this with negotiating non-competes and restrictive covenants. If you don't know what you do, it's really hard to create the non-compete, and the non-compete for you will be really broad because you don't know what you want to do. Conversely, if you say, this is what I want to go do, it's actually easier to create the non-compete, because we can carve out those elements that you want to do. If you want to give back in peer groups, hey, that's great. Most people allow you to carve those kinds of things out. They just don't want you to go directly compete with them. And so it becomes really hard to get through the restrictive covenant piece unless you have really good clarity about what you want to do.
Awesome. Well, really appreciate you all sharing your insight today. If you're interested in learning more about Blue Alliance, please check out their website, or you can email info@bluealliance.com to connect with Nick and his team. We'll also be sure to send out all of Nick's information after our follow-up email if you're interested in reaching out to him. And then really quick, here at ITV, we talk to a lot of MSP owners who typically get a valuation once they're thinking about exiting, and by then it's a little too late to influence much change. And our VAS platform gives you access to a quarterly fair market valuation and really highlights the specific areas that increase buyer confidence, so you can grow value over time, not just hope for it at the end. So if you're interested in a VAS demo, feel free to scan the QR code on your screen. And then to close us out
if
today,
I can, just before you do
Oh, yeah.
that, I just want to touch real quickly on reaching out to Nick. One of the things I love about Nick is that in the end, he wants to be a win for you and a win for him. So one of the things that I appreciate about him, because hey, we bring him transactions and oftentimes he's going, yep, that's not going to work for us. So I just want you to feel free to reach out to Nick. Nick will be very transparent with you about whether this is a good thing for him. But one of the things I like about Nick is Nick definitely has a heart to give back. And so he'll give you a lot of great advice about how to structure things, how to work things. And so don't feel like, hey, I'm, allowing the fox into the hen house here by reaching out to Nick for good questions. I know that Nick's going to treat you with integrity and is going to help you get clarity around what do you want to do, what's the right thing for you. If it is a good spot for you to be with Blue Alliance, he'll tell you that. If not, he'll also tell you that as well. So please feel free to reach out to Nick on that.
Happy to help. Absolutely. Thank you, Reid.
Bobsledding. Is it bobsledding?
No.
Oh, I didn't know
It's
Winter
not.
Olympics.
Somebody said golf in the chat. I've got these little T-Rex arms. I can't get the geometry to work. It's not golf.
There were actually two correct guesses in the chat. Clay Archer and Rich Glickman, you guys answered correctly, so congratulations on that. Clay technically answered first, but I think we have it in the budget to send you both a gift card. So we'll
Right.
reach out directly and make sure we get those Amazon gift cards to you safe and sound.
Nick,
So
real
real
quick,
quick-
I know we're running on short time. Recent favorite car that you've drove as
Oh,
relates to the.
I had the privilege of getting a new one. It's a Porsche GT4 RS Club Sport. It's like a factory race car from Porsche. It's amazing.
Nice, nice. There's always something about entrepreneurs and need for speed or adrenaline rush. I don't know. I think it's a
Yeah.
common thing that I've seen. So
It definitely is. It's definitely calming. I don't know why, but it is.
But at least race car driving gets to fall into a sport, where flying doesn't. So,
Yeah.
I don't know where I'm at. I don't even get a sport title out of the deal.
Well, do some barrel rolls, Reed, and maybe we'll call it a sport. So
Awesome. Well, thank you all again for joining today. It was a great conversation. And again, Nick, we're so grateful to have you join us and share your unique perspective. And we'll make sure to follow up with everyone this week to share the recording. But again, please don't hesitate to reach out to Nick, Reed, or Corey, or myself. And I hope everyone has a great Tuesday afternoon. Thanks
yeah,
again.
thanks for having me.
thanks, Nick.
Absolutely.